Good morning. Welcome to the course on Management of Financial Services. We shall be discussing about what do you mean by financial system, financial institutions, financial markets, and how these functions of a particular system happen, how financial markets are structured, how financial system in general is structured into different institutions and markets. If you see, what do you exactly understand by financial system? Financial system basically deals with financial transactions and the exchange of money between savers, investors, and borrowers. Savers means the household sector or the corporate sector or government or foreigners. So these all constitute to be the savers in the economy. These savers want to save their money for specific reasons. And the investors are those people who want to use that particular savings to generate certain profits. Mostly, these are the corporates which are responsible for that. We have lenders, and lenders are basically the financial institutions or banks who lend the money for specific reasons. And that reason could be investing your money in the market or buying some kind of consumable products. For any other thing, always the lenders or the banks or the financial institutions provide loan to the different stakeholders called as borrowers. Now, these borrowers can be individuals as well as institutions who want to borrow the money from the financial system. So, the financial system in general tries to integrate these stakeholders for the transaction purpose, or that is for facilitating the exchange of money between them. So overall, if you see, the basic job of financial system is to make relationship between different stakeholders like savers, investors, borrowers, lenders, and other market participants who are existing in this particular system. In general, now we can define that what exactly it does. In this context, the basic job of financial system is to provide financial services. It tries to provide certain kind of service to different stakeholders in order to maximize their return to fulfill the requirements, that is financial requirements. So now we can define it in this way. Financial systems are made up of different integrate complex models that link the financial institutions and markets in order to provide financial services. Here we are depositing the money and commercial borrowers or the corporate sector tries to take this in form of loan and use these investments and realize some returns. Finally, the money is circulated as well as there is a flow of particular money that comes into system which helps in different kind of growth activities in the economy by and large. The financial system tries to make integration between different stakeholders or make them together by that money can come into the market in a very systematic way, and finally the services or the financial services can be realized from this. In this context, there are three words which people always interchangeably use: money, credit, and finance. These are the terms which are very popularly used by the different participants in the financial system. So if you see, from a layman's point of view, money means rupees or a particular currency that people use for different reasons. So if you try to find out the proper definition of money, money is nothing but a medium of exchange. That means it is a means of payment. So if anybody wants to define money in a very systematic or a standard way, we can say that money is a particular instrument or a particular medium of exchange or a means of payment whenever we transact in the financial system or any other market which exists in this particular economy. So therefore money refers to a current medium of exchange or a means of payment. money in the aggregate sense can be defined wherever you talk about credit. All of you might already be aware about, we have two things, that is bank's passbook, right, in which some money is credited and some money is debited. So whenever we talk about credit, it is basically whenever we are expecting something to be realized from, and if you have some kind of credit, that is basically always used in a very positive sense. So and that's something that can generate revenue in future. So whenever you talk about credit in an aggregate sense, in a larger sense, it is basically the commercial banks that provide credit to different kind of other companies or corporate sector, and also the individuals who are expecting some kind of interest from that. And mostly in a true credit sense of credit, it is nothing but a loan in which the commercial banks commercial banks give to different stakeholders which are participating in the financial markets through this commercial bank, right? So they can utilize that particular resource, utilize that particular source of finance for specific purposes, and this purpose that they have taken for the loan is basically used for, again, for the same purpose for which the loan has been taken. In the end, they have to pay certain interest to commercial banks. If anybody has taken a loan, we consider it as debt for them, and if it is for us, it is a liability. That whenever an individual takes a loan, we consider this as a liability of the individual. However, we talk about the institutions who provide loan to us. For them, it is an asset. Why it is an asset? Because from this particular kind of loans, they generate certain revenue, they generate certain interest, which basically helps them to run their business. And finally, because they do the financial business, we get this particular money from them to fulfill our requirements and also to utilize that particular money for specific reasons. So that is the way credit in the financial sense we use in financial system. Then there's another term, like I said, finance. So what that's another word people very conveniently use. The finance is basically nothing but it is monetary resources which comprises of debt and the ownership of the funds of the company or an individual. Now, for example, a company wants to do the business. So how the company does the business? Company basically generates some kind of revenue by selling the products, or maybe they basically produce certain products and sell them in the goods market and generate certain kind of income for this. Now, whatever cost they have incurred to produce that product, and if you take the difference between income and their expenses, the rest of the money we call it as profit. So whenever we talk about finance, how particular company generate or maybe invest that particular money, or how the particular company generate funds to produce that product. So either the company can start the business with certain kind of resources that already they have, right? Or they can borrow this money from commercial banks or any other, they can borrow the money from any other financial institutions, or already you also have an idea that they can raise money from the markets, right? That is from general public. So they can generate money from public. Therefore, the people who have invested this money in a particular stock which is issued by the company, they become the owner, right? So because they are the stakeholders of a particular company, so that is why they become the owner. They are entitled to get certain kind of share of the profit what the company basically generates. So in that context, we can say that total finance or the financial capital in the aggregate sense, we use that is nothing but whatever the money the company has generated in terms of debt or in terms of equity, which is basically the owner's funds. So it basically takes care of the financing activities of the company, and that particular financial capital is utilized for investment in the future. So money, credit and capital, these are the different terms. These are not the same terms which are used in and these are the terms which are very frequently used in financial literature, right? So that is why we should know how these particular things are different and how these particular things are used in the financial markets by different stakeholders. Let us now try to understand the functions of financial system. What exactly the financial system does? Why we need this financial system? Do you have any idea that financial system is nothing but a system which tries to aggregate or integrate all the stakeholders who are trying to participate in the market with certain objectives. Now, these objectives can be maximization of return or, getting some kind of loan, right? So all kinds of stakeholders are basically getting certain kinds of benefits from this particular system. But in a very systematic sense, if you understand from the economics perspective, it is a way of understanding. If you see what are those functions that are performed by financial system, the one, it provides payment system of for the exchange of goods and services in the economy, right? So as we've already discussed, that any kind of exchange or any kind of transactions which takes place in the system, that is through the banks or any other financial institutions, whenever you want to put your money, you put your money in the bank, you put your money in stock market, you put your money in any other markets, commodity markets or derivatives, whatever stakeholder, whatever markets we have, what kind of stakeholders you are doesn't matter. But any medium of exchange, for any kind of exchange if you want to do, then you have to take the help of financial system, because financial system is only helpful for kind of exchange of goods and services from one particular sector to another. All the payments are basically made through banking. So if you take the example of India, also there are other financial institutions which help them for this payment mechanism. So because of that, it provides a kind of services to the exchange of goods and services in the economy at a large. Another thing that you must know is whatever income you have or whatever consumption you're making or whatever money is surplus, basically we are keeping with you. You're keeping this money at home. Does it bring you any returns? No, it has no value and it has no use. Financial system helps that if the money is surplus money in the household sector, it can go to financial system. Money can be utilized in the market, and money can be utilized by any other by the list of borrowers who take it as a loan, and it can be taken by another individual for buying a house, or it can be taken by individual for business purpose, right? So therefore it provides certain mechanism to pull the funds in the terms of household savings or for corporate investments. Finally, in the general sense, we always call housing sector basically are the savers, right? So household sector or the individual are the savers, and the business or the corporate sectors are basically investors. So once the money has been pulled out of the system, then this money can be utilized in the market by the investors, right? And it helps them to generate certain kind of revenue. Once we are making small savings, and somebody can have 500, 5,000, 5 lakh, any amount, but at the end of the day, whenever the participants or whenever that particular money is accumulated in the bank or any other financial institutions which are existing in a particular system, then this particular money helps to create long-term capital formation for the government and corporate sector or the business organization. That money can go to the government. This money can go to other private entities. They can create certain kind of capital formation in terms of financial assets, fixed assets. The money can be utilized to generate certain assets related to infrastructure, right? Now, which again is used for generating profits and revenues for the business. So it helps the individuals or the aggregate economy by and large to maximize the increase in the growth rate at a larger rate, in a very larger way. So it also provides a kind of infrastructure. It provides a platform, or it facilitates a process by which the investors and other market participants can liquidate their investments. Alternatives like stocks, bonds, right? For example, somebody wants to invest in stock. How they can invest without the help of financial system? They cannot invest without the help of financial market in the stock. Or if they want to sell the stock, then what they want an infrastructure from financial market also to sell the stock. So like that, whether it is a stock or a bond or any other gold or any other instrument, nowadays you have for various financial alternatives which are available. So those kind of assets or those kind of instruments can be bought and sold through financial system only. So therefore, it has a lot of implications for generation of resources, as well as it provides the services in terms of different instruments. And finally, those services or those instruments can be liquidated to generate cash at the time of requirement. So therefore, what we can say is that it helps to provide a larger financial services to the system, which can help the participants to liquidate whatever financial alternatives they are holding. So there are enough financial alternatives which are available. They are able to, or the market participants are able to minimize the risk because they can diversify the risk because enough alternatives are available in the market. Therefore, we can say that it also helps for minimization of risk, right? Because all of you know that if you are holding more assets in your portfolio, then the unsystematic risk can be minimized. So we are going to discuss this elaboratedly in the later sessions on this course. So for now, we can say that if you're holding more assets and more types of assets in your portfolio, then in one case, right, you're losing. That is the possibility that other assets can perform better than you make in. So because of that, it can say that it provides avenues for managing the risk, because all type of funds which are coming to the market, it does not have any it does not have any kind of very biased kind of requirements, right, or biased kind of terms to maturity. So like I've already shared, it provides a financial capital to the government or for the public expenditure on different infrastructure for different infrastructure projects, and that the infrastructure projects in future, you know, they will generate excess revenue and maximize the welfare of the people in the economy by large. Another thing, if you see, you know, the financial market provides the price information, right? Now it provides the price information. Uh, at what price we should buy a particular stock, at what price the bond should be issued. Also, it can give you an idea that whether whatever price you're paying for some kind of a set, whether it is a price which is fair or not, whether the price is really you know, the price which is in the equilibrium with the system or not. So basically, we can't get it wherever we have a definite financial system, and financial system is able to provide that kind of information to us, and it also helps in reduction of systematic information and moral hazard problem, which is you know, which in turn facilitates reduction of the transaction cost. Now let's elaborate a little more on this. So whenever we are investing in the market, we want to participate in the market. Always we should ensure that the cost that we are bearing in the market should be less. So, but how the cost can be minimized? So the cost can be minimized whenever you have all informations, right? So if somebody is selling a bike, somebody is buying that bike, particularly the old bike, then you will have to find the person who basically is selling the bike. This old bike has all the information about you know, the bike that is what the person is buying. Now in that context, what happens, the buyer always says that he feels that he should pay less, but the seller always feels that he should get more. So then that particular thing creates certain kind of risky situation in the market, because there is a systematic information, and finally what will happen, the price what they will get, the price, that price may not actually be a fair price for the investors, right? They can, or particular buyer and seller can finally decide upon. So if there is a system which is there are so many participants are available, as well as the financial system can integrate all of them and bring them together, then what will happen, finally the price what basically will be decided, that prices can be fair price, can be equilibrium price in the system at the large. It creates an investment opportunities to maximize the return that is related to portfolio. Part of that already is shared with you. It also helps in efficient allocation of resources, because there are so many stakeholders, and it caters the demand for all the needs in that context. Whoever needs, or whatever purpose the financial system is able to cater this demand for this particular investors or for the market participants. So therefore, it plays a very, very significant role for economic growth, and it creates demand supply of funds. And we can say that because the change in the demand and supply have an impact on interest rate in the market, then it basically affects total money supply, inflation, and foreign investments. So all those details in general, we are going to discuss in a very elaborated way in the upcoming sessions. So, but this is the way the financial system basically helps. That is why we can say that these are the major functions of financial system. So we have two types of markets. Broadly, one is money market and the second is capital market. The conventional distinction is basically based on maturity period. Almost all the financial markets provide certain instruments, certain services in detail that we are going to discuss. But if you see the actual with the formal definition, the money market deals with short-term claims with a maturity of less than 1 year. Some people argue that money market can deal up to maturity of 3 years. Although this is a formal definition, sometimes maturity period can also go up to 3 years. But capital market basically deals with relatively longer term maturity. However, we have given definition that the period should be more than 1 year, but in some cases, you can see that the period can be more than 3 years also. In aggregate, I can say that you can take a short-term period of 3 years maturity, and if the period maturity is more than 3 years, then we may call them long-term market. So that is the way this is defined, and mostly this money market, like all money market, reserve money market, certificate of deposits market, commercial papers market, these are basically called as the money market, the capital market, stock market, corporate market, etc. I also told you that every market has two segments, primary or the secondary. So coming back to the slide, there are many kinds of financial markets, including forex, money, stock, bonds, and these markets may include assets or securities that are either listed or on regulated exchanges or traded over the counter. Financial markets trade in all types of securities and are critical to the smooth operation of capitalist society. So when the financial markets fail, economic disruption, including recession and unemployment, can result. The primary market here basically deals with new financial claims or new securities which are coming to the market. That means this is the new addition to the system and how these securities are issued. What is the process of issuing that security? This all we are going to discuss. And the secondary market means once in the primary market, the money comes or the particular the securities come to the system depending upon the demand and supply, basically are always traded in the market depending upon the demand and supply of the price basically fluctuates that of the security. So these are basically, we call them as instruments of the secondary market. So somebody for the first time issue share, we call it as IPOs. And once they're listed in the stock exchange, we call them as the instruments of secondary market. That is why the secondary market deals with securities which are there, and the price fluctuation happens because of demand and supply of the security in the particular system. So there are different types of financial markets. Stock markets, perhaps the most difficult of financial markets are stock markets, because the stock markets are quite unpredictable. There are venues where companies list their shares and they are bought and sold by traders and investors. Stock markets or equity markets are used by companies to raise capital via an IPO, with shares subsequently traded among various buyers and sellers in what is known as secondary markets. Stocks may be traded or listed on exchanges such as New York Stock Exchange, Bombay Stock Exchange, National Stock Exchange, or else over the counter. Most trading in stocks is done via regulated exchanges and these play an important role in the economy as both a gauge of the overall health of the economy as well as providing capital gains and dividend incomes to the investors, including those with retirement accounts, etc. Typical participants in the stock market include retail institutional investors and traders, as well as the market makers, the specialists who maintain liquidity and provide two-sided markets. Brokers are third parties that facilitate trades between buyers and sellers, but who do not take an actual position in the stock. Second, we have OTC market. Over-the-counter market is a decentralized market, meaning it does not have physical locations, and trading is conducted absolutely electronically, in which market participants trade securities directly between two parties without a broker. While OTC markets may handle trading in certain stocks, smaller or riskier companies that do not meet the listing criteria of the exchanges, they go to OTC market. So most stock trading is done by exchanges. Certain derivative markets or however are exclusivity the OTC, and so they make up an important segment of financial markets. Broadly speaking, OTC markets and the transactions that occur on them are far less regulated, less liquid, and are more opaque in nature. Now we have bond market. Bond market is a security in which investor loans money for a definite period or a defined period at a pre-established interest rate. We may think of a bond as an agreement between the lender and a borrower that contains the details of the loan and its payments. Bonds are issued by corporations as well as municipalities, states, sovereign governments to finance the projects and operations. The bond market sells the securities such as notes and bills issued by the they are issued by the Treasury. Now, the bond market is also called as debt, credit, or fixed income market. Then we have money market. Typically, money market trades in the products with the highly liquid short-term maturities, that is less than 1 year, and are characterized by high degree of safety and are relatively low on returns in interest. At the wholesale level, the money markets involve large volume trades between institutions and traders. At the retail level, they include money market, mutual funds bought by the individual investors, and the money market accounts opened by the banks of the customers. Individuals may also invest money in the money markets by buying short-term certificates of deposits or treasury bills, etc. Then we have derivatives market. Derivative is a contract between two or more parties, whose value is based or agreed upon some underlying asset. Like sugar derives its value from sugar cane, right? So sugar becomes a derivative product. So derivatives are secondary securities whose value is solely derived from the value of the primary security that are linked to. In and of itself, a derivative is worthless. Rather than trading stocks directly, a derivatives market trades in futures and options contracts and other advanced financial products that derive their value from the underlying instruments like bonds, commodities, currencies, interest rates, market indices, stocks. So future markets are where future contracts are listed and traded. Unlike forwards, in which OTC futures markets utilize the standardized contract specifications, are very well regulated and utilizes the clearing houses to settle and confirm the trades. Options markets are similarly, they are listed and regulated on options contracts. So both futures and option exchanges may list contracts on various asset classes such as equities, fixed income securities, commodities, and so on. Then we have forex market. Forex market is a market in which participants can buy, sell, hedge, speculate on the exchange rates between currency pairs. The forex market is most liquid market in the world. As cash is most liquid, so the currency market all over globally, it handles $7.5 trillion transactions, daily transactions, which is more than the futures and equity markets combined. As with the OTC markets, the forex market market is also decentralized and consists of global network of computers and brokers all around the world. So the forex market is made up of banks, commercial companies, central banks, investment management firms, hedge funds, and retail, forex and brokers and investors, etc. Then we have commodity markets. They are the venues where producers and consumers meet to exchange physical commodities like agricultural products, precious metals, soft commodities. So they are known as spot commodity markets where physical goods are exchanged for money. The bulk of trading in these commodities takes place on the derivatives, that is certain underlying assets. Forwards, futures, options on commodities are also exchanged both OTC and on the exchanges. So now a newly evolved market is cryptocurrency market. So the past several years have seen, the introduction of cryptocurrencies such as Bitcoin, Ethereum. So they are decentralized digital assets that are based on blockchain technology. So today, thousands of cryptocurrency tokens are available and traded globally across a patchwork of independent online crypto exchanges. These exchanges host digital wallets for traders to swap one cryptocurrency for another, or for fiat money such as rupees, dollars, euros. So because the majority of crypto exchanges are centralized platforms, users are susceptible to hacks and frauds. So decentralized exchanges are also available that operate without any central authority. So these exchanges allow direct peer-to-peer trading of digital currencies without the need for actual exchange of authority to facilitate the transactions. Future and options trading are also available on major cryptocurrencies.